If your business earns $300,000 a year but struggles to save even $15,000, is it truly stable? What if a $30,000 expense hits unexpectedly? In this video, you will learn the 777 rule that shows how strong your business finance really is. Rule number 1, 7 times interest coverage ratio. Let's start at the beginner level. When a business takes a loan, it must pay interest every year. That payment is not optional. Whether sales are strong or weak, the bank still expects its money. So the real question is not, can I pay interest this year? The real question is, how comfortably can I pay it? This is where the interest coverage ratio becomes powerful. The formula is simple. EBIT divided by interest expense. EBIT means earnings before interest and taxes. In simple language, it is your operating profit before paying interest and taxes. Now, let's use numbers. If your business earns $700,000 in EBIT and your yearly interest expense is $100,000, your coverage ratio is 7 times. 700,000 divided by 100,000 equals 7. That means your business earns 7 times more than what it needs to cover interest. Why is 7 times important? If your coverage is only 2 or 3 times, your business is fragile. A small drop in sales can create stress. A recession, supply problem, or cost increase can push you into danger. But at 7 times coverage, you have breathing room. Even if profits drop by 30 or 40%, you can still comfortably pay your interest. Banks see this as strength. Investors see this as discipline. For beginners, here is your action step. Calculate your operating profit. Divide it by your yearly interest cost. If the result is below 4 times, your debt level may be risky. If it is 7 times or higher, your business is financially strong. This rule protects your company from collapse during tough times. It forces responsible borrowing and long-term stability. Debt is not dangerous by itself. Weak cash flow is what makes debt dangerous. When your interest coverage is strong, you control the debt instead of the debt controlling you. You can negotiate better terms, refinance when rates drop, and expand with confidence. But when coverage is thin, every slow month feels like a threat. The 7 times standard builds psychological strength as well as financial strength. It gives you stability, credibility, and strategic flexibility in uncertain markets. Rule number 2, 7% levered free cash flow margin. Now let's talk about something most beginners misunderstand. Profit is not the same as cash. A business can show strong net income on paper and still struggle to pay bills. Why? Because accounting profit includes non-cash items and timing differences. What really matters is how much actual cash is left after everything is paid. This is where levered free cash flow becomes important. Levered free cash flow means the cash your business keeps after operating expenses, taxes, capital expenditures, debt payments. It is the real money available for growth, reserves, or owner distribution. Now let's understand the 7% rule. Formula is levered free cash flow divided by revenue. If your company generates $5 million in revenue and produces $400,000 in true free cash flow after debt payments, your margin is 8%. 400,000 divided by 5 million equals 8%. That means for every dollar of revenue, you keep 8 cents in real usable cash. Why is 7% powerful? If your margin is below 3 or 4%, your business is operating too tightly. One unexpected expense can erase your flexibility. Scaling becomes dangerous because growth consumes more cash. At 7% or higher, your business produces healthy internal cash. That means you can reinvest without always borrowing. You can build reserves. You can survive downturns. You can negotiate from strength. For beginners, your action step will be like this. Do not stop at net profit. Calculate how much cash actually remains after all obligations, including loan payments and reinvestment needs. Then divide that number by total revenue. If you are consistently above 7%, you are running a cash-strong business. If not, you need to improve margins, pricing, or cost structure. Cash is freedom. Accounting profit is just a report. Growth without cash discipline is dangerous. Many businesses increase revenue but quietly lose financial control because cash is not keeping up with expansion. A healthy free cash flow margin above 7% means your company is funding its own future instead of depending entirely on lenders or investors. It gives you flexibility during slow seasons and confidence during expansion. When real cash remains after every obligation, you are not operating on hope, you are operating on strength. Strong cash flow turns opportunity into action and uncertainty into manageable risk. Rule number 3, maximum 7-month cash conversion cycle. Now let's talk about operational efficiency in a way beginners can clearly understand. Your business does not just make money, it moves money. You buy inventory. You sell products or services. You wait to get paid. The time between spending cash and receiving cash back is called the cash conversion cycle, or CCC. The formula is simple. Inventory days plus receivable days minus payable days. Inventory days means how long your products sit before being sold. Receivable days means how long customers take to pay you. Payable days means how long you take to pay suppliers. Now here is the rule. Your total cash conversion cycle should not exceed 7 months. Why? If your cash is locked inside inventory and unpaid invoices for too long, your business becomes cash-starved, even if revenue looks strong. Let's use a simple example. Inventory sits for 3 months. Customers take 4 months to pay. You pay suppliers in 1 month. 3 plus 4 minus 1 equals 6 months. That means your cash is tied up for 6 months before returning. If this number grows beyond 7 months, your growth becomes stressful. You may need loans just to fund daily operations. But when your cycle is controlled under 7 months, cash flows faster, you need less borrowing, expansion feels smoother, risk decreases. For beginners, here is your action step. Track how long inventory sits. Track how fast customers pay. Negotiate better payment terms with suppliers. Reduce slow-moving stock. A shorter cycle increases liquidity without increasing sales. This rule teaches operational discipline. Strong businesses do not just earn profit, they move cash efficiently and keep control of their working capital. If you found this video helpful, then like, share, and subscribe this channel to get more videos. Thank you for watching this video.